Have you ever wondered how the shifting valuations of office spaces might impact the city budgets they're nestled in? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a recent article by Grant Welker, it was reported that Boston's office valuations are expected to plummet further, posing a significant strain on the city's budget. The declining valuations are a reflection of the ongoing challenges within the office real estate market as remote work trends continue to reshape the landscape. This trend is not only a concern for property owners, but also for municipal budgets that rely heavily on tax revenues generated from these properties. The situation in Boston mirrors broader trends seen across major cities in North America, where office spaces are being reevaluated and repurposed in response to new workplace realities. This shift is indicative of a larger transformation within the commercial real estate sector, where adaptability is key to navigating the evolving market demands. While Boston grapples with these valuation challenges, cities like Kitchener-Waterloo, London, and Cambridge in Ontario are also experiencing their own shifts in the commercial real estate market. These Canadian cities are witnessing a demand for multifamily and industrial spaces, driven by a growing population and a need for more flexible work environments. In contrast, the United States sees a similar need for adaptability, with a focus on converting office spaces into multifamily housing to meet the changing needs of urban residents. The cross-border relevance of these trends highlights the interconnected nature of the commercial real estate market. As cities on both sides of the border navigate these changes, the focus remains on finding innovative solutions to maintain economic stability and support community growth. In a significant transaction, CBRE has successfully negotiated the sale of a multifamily portfolio in downtown Phoenix for $90 million. This portfolio, comprising 3 distinct properties, Linear, Illuminate, and the McKinley, includes a total of 323 units. These boutique, Class A multifamily communities are situated within a half-mile of each other in the vibrant Roosevelt Row neighborhood. Regent Properties, a vertically integrated real estate investment management and development firm, acquired the portfolio. This marks Regent Properties' first foray into the Phoenix area multifamily market. CBRE's Asher Gunter, Matt Pesch, Austin Groen, and Sean Cunningham represented the seller, Barron Properties, while Jesse Weber and Andrew Behrens of CBRE Debt and Structured Finance arranged financing for the buyer. The properties, built between 2016 and 2020 by Barron Properties, feature high-quality podium construction, air-conditioned interior corridors, multiple elevators, resort-style swimming pools, rooftop patios, and contemporary urban design aesthetics. This acquisition underscores the continued interest from institutional investors in downtown Phoenix's multifamily assets. Regent Properties, founded in 1989 and based in Los Angeles and Dallas, is an SEC-registered investment advisor. The firm is a vertically integrated operator and fund manager with investments concentrated in 8 Sunbelt markets, managing assets worth $1.8 billion as of the end of March. Sam Krause, Chief Investment Officer of Regent Properties, expressed excitement about entering Phoenix's multifamily market and contributing to the growth of the Roosevelt Row neighborhood. Roosevelt Row, known as the cultural epicenter of Phoenix, is a walkable arts district that features museums, galleries, cafes, bars, and a vibrant culinary scene. Downtown Phoenix serves as the metro's largest employment hub, supporting approximately 138,000 jobs. Matthew Riggs, president of Barron Properties, highlighted the property's performance, attributing their success to their boutique nature, best-in-class floor plans, and prime location. Newmark Group Incorporated has announced the successful arrangement of a significant transaction involving the sale of the iconic office tower located at 601 South Figueroa Street in downtown Los Angeles' financial district. This high-rise, known as 601 Fig or Fig at Wilshire, encompasses 1,041,315 square feet and was sold for $210 million, which equates to approximately $202 per square foot. The sale was facilitated by Newmark's co-head of United States Capital Markets, Kevin Shannon, along with Vice Chairman Ken White, Rob Hannon, Laura Stum, and Michael Mall, and Director Alex Beaton. The team represented the undisclosed seller in this transaction. Additionally, Newmark's Executive Vice Chairman and Head of International Capital Markets, Alex Fache, collaborated with the team to ensure a seamless process. The office tower, completed in 1990, is situated at the renowned corner of Wilshire Boulevard and Figueroa Street. It boasts a distinctive octagonal design and a glass crown that contributes to downtown Los Angeles' skyline. The property offers a variety of amenities, including dual lobbies with a 75-foot atrium, a modern fitness center, a Wi-Fi-enabled open-air plaza, and on-site dining options. At the time of the sale, the building was 72% leased to tenants from diverse industries, with PricewaterhouseCoopers serving as the anchor tenant. Its prime location provides easy access to key downtown Los Angeles destinations such as the Crypto.com Arena, Microsoft Theater, LA Live, and the 7th Street Metro Station, which is a central rail hub. This transaction highlights the ongoing interest in prime office assets in major urban centers, even as the commercial real estate market adapts to new workplace realities. It underscores the importance of strategic locations and amenities in maintaining the appeal of office properties in today's market. In a notable development within the commercial real estate sector, a local developer in Chicago has acquired a vacant office building in the River North neighborhood with plans to convert it into approximately 90 residential apartments. This project adds to the growing pipeline of office-to-residential conversions happening in downtown Chicago, reflecting a broader trend of repurposing underutilized office spaces to meet the increasing demand for housing in urban areas. The building, located at 50 East Superior Street, is a 7-story structure nestled mid-block between Rush Street and Wabash Avenue. This conversion is part of a significant shift in the commercial real estate landscape, where developers are increasingly looking to transform empty office buildings into residential units, responding to changing market dynamics and the evolving needs of city dwellers. The trend of converting office spaces into residential units is not only prevalent in Chicago, but is also seen in other major North American cities. This shift is driven by the ongoing changes in workplace habits, with more people working remotely, reducing the demand for traditional office spaces. As a result, cities are reimagining their urban cores to accommodate these new living and working patterns. In Kitchener-Waterloo, London, and Cambridge, Ontario, similar trends are emerging. These Canadian cities are witnessing a growing interest in multifamily and industrial spaces, driven by a booming population and the need for more flexible living environments. These shifts highlight the cross-border relevance of real estate trends as both Canadian and American cities adapt to the new realities of urban living. The conversion of office buildings into residential apartments is gaining traction as a viable solution to address housing shortages in densely populated urban areas. This approach not only revitalizes underused spaces, but also contributes to the economic vitality of downtown districts by attracting more residents and supporting local businesses. As the commercial real estate market continues to evolve, the focus remains on finding innovative ways to repurpose spaces to meet current and future demands. The transformation of office buildings into residential units exemplifies the adaptability required to sustain growth and development in today's urban environments. A recent report by the National News Desk highlights the ongoing transformation in the commercial real estate sector, with more office spaces being converted or demolished amid shifting workplace dynamics. The pandemic and the rise of remote work have significantly impacted the demand for traditional office spaces, leading to a rebalancing of the market. According to Jessica Morin, the director of United States Office Research for CBRE, while it's too early to claim a full recovery in the office market, there are signs of stabilization. She noted that the majority of office occupiers have adjusted to remote work policies, with many companies expecting employees to be in the office 3 or more days a week. However, less than 10% expect a full return to in-person attendance. CBRE's surveys indicate that more companies are planning to maintain or expand their office portfolios, despite the current high vacancy rate of around 19%. This year, for the first time since at least 2018, office conversions and demolitions are expected to exceed new construction, with 23.3 million square feet of office space set to be repurposed or torn down. The majority of these conversions are being transformed into apartments, which are often easier to lease than office spaces. The trend of converting office buildings into residential apartments is particularly notable in cities like Manhattan, Washington, D.C., and Houston, which have significant office square footage planned or under construction for conversion. Cleveland and Cincinnati also have large shares of their office spaces under conversion. This shift is not only a response to the changing workplace habits, but also reflects a broader strategy to address urban housing shortages. The conversions contribute to the economic vitality of downtown districts by attracting residents and supporting local businesses, illustrating the adaptability required in today's real estate market. Despite the high vacancy rate, office leasing activity has increased by 18% in the first quarter compared to the previous year, and net absorption has been positive for the past 4 quarters. These trends suggest a cautious optimism about the future of office spaces as they continue to evolve to meet new demands. As we wrap up today's episode, it's clear that the commercial real estate landscape is undergoing significant changes. The adaptability of the sector to repurpose spaces and meet current demands is crucial for sustaining growth and development. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.